Understanding startup financing. Equity and dilution. Startup financing is a journey of strategy and foresight. In this video, we'll break down the essentials: equity distribution, valuation, and how fundraising dilutes ownership. Join us as we unpack these concepts through Company A's story, illustrating the effects of each funding round on shareholder percentages and core financing concepts. Let's start with some essential definitions. What is nominal share value and equity distribution? The nominal share value is the base value of a company's shares, serving as the foundation for equity distribution among founders and investors. What are pre-money and post-money valuation? Pre-money valuation determines the company's worth before new investments. Post-money valuation recalculates the company's value after incorporating the investment, essential for new share distribution. What is share issuance and dilution? New capital raises involve issuing additional shares, which dilutes the ownership percentages of existing shareholders. This dilution is a trade-off for essential capital needed for growth. Let's continue with a detailed example of Company A's path to growth. Company A is initiated with a $100,000 investment from its two founders, knowing that initially, 100,000 shares are issued, meaning Company A nominal share value is $1. Founder 1 owns 40,000 shares, worth $40,000, which is 40% of overall shares. Founder 2 owns 60,000 shares, worth $60,000, which is 60% of overall shares. Let's assume that Company A has initiated the first round financing. The pre-money valuation is assessed as $5 million, meaning share value moves from $1 to $50 per share, which is $5 million divided by 100,000 shares. Founder 1 owns 40,000 shares, worth $2 million, which is 40% of overall shares. Founder 2 owns 60,000 shares, worth $3 million, which is 60% of overall shares. The first round investors contribute $2 million, meaning the company will need to issue 40,000 new shares, which is $2 million divided by $50. This is raising the company post-money valuation to $7 million, which is $5 million plus $2 million. Now, let's talk about the ownership after the first round. After 40,000 new shares issued, the total company number of shares will be 140,000, diluting existing ownership percentages. Founder 1 still owns 40,000 shares, worth $2 million, but the percentage moves from 40% to 28.57% of overall company shares. Founder 2 still owns 60,000 shares, worth $3 million, but the percentage moves from 60% to 42.86% of overall company shares. First round investors now owns 40,000 new shares, worth $2 million, which is 28.57% of overall company shares. Now, let's explore Company A's fundraising. Company A's fundraising journey highlights the balance between gaining investment and adjusting ownership. With each funding round, new investors come on board, changing who owns part of the company and validating its valuation at each stage. What are insights for founders? Founders need to understand the impact of investments on ownership and company valuation. Company A's experiences emphasize the importance of smart negotiation and managing how investment rounds affect both the value and ownership of your business. For more information, visit us at www.evolutco.com.